Hi, everyone. Thank you for joining WisdomTree's Office Hours with Professor Siegel on FedWatch. What comes next? Where you will hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy. Now, with that, I'll turn it over to Jeremy Schwartz for some opening remarks.
Professor Siegel, Kevin, always great to be on with you in these post-Fed inflation kind of recaps. Professor, you were out with a hot take on the Fed this week. You wrote an op-ed for Fortune, giving your take on what it is. It didn't seem like the Fed was going to follow your advice, but we got an interesting 50 bip cut, and we'll be great to get your take on what you heard.
I'll have to say I am surprised. I was saying, of course, I wanted 50. You know, I even wanted more. But I didn't think he was going to do it. If you had me choice, I was in the 25 mold. It's interesting that the markets were almost 50-50, but of I think I saw the report 125 Bloomberg economists that weighed in on the issue. Almost 90% thought it was only going to be 25. Okay, so what is it? We got 50. We also, by the way, got an admission that if he had the July employment report in hand for the meeting, which came out a couple days later, he would have dropped 25 last July. So I mean, they realized that they were a bit behind the curve, and now they are catching up. Interesting market reaction. Of course, I think the 50 is good because I think they need to go down. They are 100%. At goal on labor market, and they are 80 to 100% on goal, depending on which data you use on inflation. And they move 50 basis points, so they move 20% towards goal on what it is. They also raised, by the way, the long-term rate. I was surprised. I thought their long-term neutral rate would go up to 3% from 2.8. It only went up to 2.9. So that sort of shows you, how far away they still are, because, what are they now? I mean, they're basically 4.9. I mean, about 4.83 if you want to be exact on what they are. What's also sort of interesting is the market, as expected, jumped, but not closed a bit lower. The bond market dropped and a yield, and now is higher. Let me tell you my interpretation of the bond market. I know Jeffrey Gundlach was on CNBC, and he was questioned about that. He didn't seem to be so sure of why it is. He said, well, maybe it's because they worry about inflation. But then his whole story, every other thing he said is inflation going down, down, down. My feeling is it lowers the probability of a recession. And, this is good for yields. So, my feeling is there's a little bit of that risk premium that is built into the yield curve on the downside. Yeah, I'm going to hedge against, the Fed being way too slow in inducing a recession. Okay, maybe the Fed won't be that slow, and therefore the economy will be stronger. I mean, to be truthful, yeah, I mean, the recent data is strong. Not only is the Atlanta Fed at 2.9, which, by the way, they're often a little too high, but Goldman Sachs is there too. So and they're more on target. So we're 2.5 to 3 on this third quarter so far. And the data is not yet showing really any market weakness, and I thought that those people might prevail at that meeting. We had, of course, one dissent, the first by a Fed governor in almost 20 years. Wow. So on only going 25 basis points, using the argument, hey, this economy is strong and we haven't killed inflation yet, but certainly overruled by the other 18 people on the FOMC. It's a much more aggressive target. If you take a look at the SEP dot plot, wow, that we have. Let me just, and I'm going to compare it with the futures market for you here. I mean, just think about this. At the September meeting, no, let me get the right one over here. Yeah. At the June meeting, they thought the end of year Fed funds was going to be 5.1. Now they think it's 4.4. So that's 3 cuts more. At the end, in the June meeting, they thought the Fed funds at the end of next year was going to be 4.1. Now they think it's going to be 3.4. So that's also 3 cuts more for that meeting. And now they think that at the end of 2026, they're going to achieve that long run of 2.9. While at the June meeting, they were still at 3.1. And remember, the neutral then was 2.8. So it's a much more aggressive look at the cutting that the Fed is going to undertake. Now, how does that compare with the futures market? I did this, and this is a really important point. I've made it with you guys. It doesn't seem like anyone in the financial markets gets this. But let's go over it. Right now, Fed funds futures for January of 25 are 409. The Fed's estimate is 440. So basically, there's a 1 cut difference. Remember, the Fed funds includes the hedge that if things really turn south, it's one of the best assets you can hold. It's an insurance policy. It's a negative beta asset. So as a result, it will always understate the expected number, overstate the expected number of cuts in this case, understate the rate. Always. You cannot calculate probabilities of cuts. Now, when you're as near as, tomorrow or a week from now, you're not going to suddenly, fall off the cliff and have a recession. Then you can calculate those rates. But when you go out 6 months, a year and a half, you are dealing with a lot of risk premium in here, and a lot of bias. Now, for instance, we don't, the SEP only go year end. So let me get you the year end Fed funds for 2025. 2025 is 340, but the Fed funds is at 287. So that's about 2 cuts difference. And I approximate as being about a 2-cut hedge that is built in there. The July 25 Fed funds is at 305. So 305, compare that right now. So with today's 50 basis point cut, we have 483. If you take out, let's say 150 basis points, you're at 333, right? I mean, we have 6 meetings left, and to June including June of next year. 2 of this, and then the first 4. 25 basis points is 150. 150 from the rate that we went down to today is 333. I think that's pretty consistent with a 305 Fed funds rate, because that's a 1 cut, 287, again, 305 Fed funds rate. That's a 1 cut premium that we have there. So, you're going to get at the Fed that the market is still much more aggressive than the Fed. No, the market and the Fed are really very much in line now with those Fed funds futures containing that risk premium that we see in here. Now, let's go back to long run values so we can get this anchor and what this might mean for the market. I have said that I said that the Fed has raised it to 2.9 as their long run. I think the long run is between 3 and 5 and 4 on the Fed funds. So, we are now at 125 basis points really away now from that longer run. I mean, I think we should be further along, given that we made 100% progress on one of the goals, 80 to 100 on the other goal. So, my feeling is we should be closer, but hey, so we're going to have a few months where we're tighter than we should. Let's just hope that that doesn't derail the economy. At this point, doesn't look like it will derail the economy going forward. But I think the long run Fed funds rate is 3.5 to 4, and the long run 10-year bond is 4 to 5. And now it's 3.7. I think bond is not a good buy right now. Now Jeffrey Gunlock was on. He thinks a recession started this month, and the data is going to come in, and the Fed's going to be more aggressive. I don't think so, unless I see something spike in the next couple of days. But he uses a complicated. He's been much more pessimistic than I, and I've been talking about the dangers here. I don't see that particularly happening here. So I don't like the long bond at 3.7 from a long-term standpoint at all. I think it's and I think the Fed funds is still too high, but we're moving in the direction, and the Fed is clearly open. Now, another word that was used by Gunlap, we're recalibrating. Now, what does recalibrating Fed funds mean? What that means is that we are now going to look at where we think we should be given these relative, rather than hang on every single data point. Not that they're not going to be important, but in a way, I think are taking that message. How can we say the long run is 2.9? And I don't even think it's that low, but we say the long run is 2.9, and we're still we're right now at 4.8. That's almost 200 basis points different. So why are we going so slowly? We recalibrate how we're going to basically move forward. Now, we didn't get a great reaction in the stock market, maybe because, again, there were a lot of stock bond allocators, so they saw a 2-3 basis point rise in that. They probably allocated a little bit as a result. We did see small stocks, the Russell 2000 just squeaked out a narrow gain over here. But let me tell you, this is good for small stocks. This is good for dividend-paying stocks, because if we're on the path to these rates, and then all of a sudden people think, well, now I'm going to get a 4% dividend-paying stock. This is higher than the Fed funds, and I got all the growth and the inflation protection that I don't have with the Fed funds. And we saw really, as I say, in fact, it looks like the strongest section of the market right now was that, basically of the broad indices was that small stock. They're going to benefit the most. Small companies have been hurt the most by the high interest rates. They finance short term much more than they finance long term. They don't have the equity ability to finance as big tech stocks are going to do. This is good, I think, for that class of stocks, and their PEs are reasonable. I think this could be the rally, the start of a good rally. On that, now that he signals to being more aggressive, we'll see as far as that's concerned. So, look at 21 times earnings, that includes the tech sector. What happens if we take out tech, Jeremy? What already are we at 18?
Yeah, the non-tech S&P is around 18.
Right. So non-tech is 18. 18 is 5.5% real return going forward. Real return going forward at 2.5% inflation. That's an 8% annual rate of return going forward, and that's going to beat the bond. But this is this sort of start. Everyone is now going to think, oh my goodness, when my CD or my Treasury bill expires. I'm going to be renewing it not at 5.5%. I'm going to renew at 4%, and then maybe the year after that at 3%. So how am I going to plan my long-term portfolio? Kevin, do you want to add anything to this?
Yeah, I wanted to just, I couldn't agree with you more on the Treasury 10-year yield. Completely in your camp on that being at 3.7. It was almost 355 yesterday.
Yeah.
It's interesting. On the bond trading floor, we always had an expression taking the other side of the trade, and I saw a question come in. We're all talking about rate cuts, how much they're going to be, where we're going to end up in 2026. What would it take, or perhaps it doesn't take anything, maybe it doesn't happen, but what would it take for the Fed not to cut rates as the dot plots were projecting, say just for the rest of this year?
Oh, it would have to take a big, all of a sudden commodities start taking off. Oils and the commodity index. It doesn't look like that at all. But, and by the way, the Fed is so inertial that even if the commodity index starts taking off, I don't think there's enough people there to say that then they'll go 25. I mean, I don't know if there's a big increase in more in the Middle East that cuts oil and oil goes to 100. I mean, you got a lot, then everything is all these are off the table on what they might do. But absent something like that, they're definitely on a minimum trajectory, I think, of 25, unless we really get a sort of a blow up and the commodity index starts going up. I mean, what's interesting is that the commodity index has come off its lows a bit, but the dollar's been very weak, as you know. I mean, it's almost all just a dollar effect. It's not a commodity world commodity effect, and world commodities are still really quite quiescent in their price. But I'll tell you, if commodity takes off, I could see a cut, two cuts, and then a stop if things take off. And they do it 1 and 2, and then they say, "Woo, maybe we should pause this until we see whether this is temporary or not." I mean, I don't see that. In fact, Jeffrey Gunlock was right in our camp about talking about real inflation being under 2. He thinks that once those lower rental rates get into the data, they're going to be very persistent next year, and we're going to see a whole string of CPIs that are going to be, especially with oil and gasoline, unless they jump up again because of war in Mideast, we could see a whole set of CPIs that are under 2%, raw, not core, but raw CPIs that are under 2% on a year-over-year basis.
Anything on the jobs number front, if we were to get, say, between now and November 7th, rebound in payrolls, say the unemployment rate stays at 4.2, you think they're still on autopilot for 25?
I think they're not. I would say they're on autopilot for 225. I mean, it would take a lot to jar 225-point increases November, December. Then with that, whether they go 51 or not, I mean, the expectation is, maybe one of those is good, maybe one of those is going to be 50, but 225 does give you 100 basis points,
right,
in 4 months, which is a chunk on that, even if they don't do it. But I think they're virtually on autopilot on 25 going down. But then, of course, if things really do heat up, and not just on the job front, you have to see the unemployment rate going down. You'd have to see the jolts turn around. Again, he quoted many indicators. That's just one. By the way, as I mentioned in my commentary, for the August payroll, although the headline unemployment rate did tick down 0.1 from 4.3 to 4.2, notice the U6 actually continued upward. Interesting, that was never brought up either at the news conference today as showing a weakness in that indicator. We'll have to see how that indicator. A lot of people look at that indicator almost as importantly as the U2 indicator, which is the main unemployment rate.
We talked about this last week, Professor, on Behind the Markets a little bit. We get a bunch of questions about the inverted yield curve, why it hasn't caused the recession, and the things that, what's unique about this cycle. That one of those questions came in again. Do you want to just sort of share for people what your view on all that is?
Yeah, for those of you, I think it has a lot to do with the fact that inflationary expectations during the last inflation episode, which really began on the pandemic and became very hot in 2021, early 2022. Inflationary expectations long-term never really went up. People thought it was temporary. Then they finally saw the Fed move real aggressive, and they said, okay, I'm not going to change my longer term. So we had a little bit of an uptick, but not much. Because you don't have a big uptick, you don't have to create a recession to kill those inflationary expectations. And one of the most damaging aspects of an economy is a buildup of inflationary expectation, because then people don't believe the central bank, and they say, show me you're serious. Well, the only way you show that they're serious is you actually, cause a recession. Now, I'm serious. All right. I'm putting people out of work, and product market's going to be weak, and you're going to see prices going down. We didn't have to do that because people thought themselves that prices were not going to go up as much. At least that's my explanation for why. Now, again, I could be wrong. Gunlach is right, and the recession started in this month. Maybe that that reliable or erstwhile reliable inverted yield indicator might finally prove its worth. But I'd say the odds are against it, but not impossible.
The other question we're getting a lot about, and continued this week at Future Proof, some more questions about debt and deficits and the impact on the yield curve. You said you don't love the 10-year at 3.7. How much, as you think about the extra risk premium in that yield curve number for the 10-year at 3.7, how do you think about the level of inflation we get from the debt and deficit issue that we have?
Well, I think there's a lot of issues going on. I mean, I think, that we may settle on 2.5%. They say 2, and we may go below 2 because of the disinflation in oil and shelter. But the truth of the matter is, when you have a lot of pressures, you're going to have military spending, and you do have that deficit. If we get into another crisis, are we going to spend, like crazy people like we did for pandemic? I mean, that's it. I mean, that's one reason why you're not getting down. You'll never get that 10-year down to 1.5, or 57 basis points ever, because we saw what could happen. You get a bad outcome of any sort, and the Fed, and the government spends a lot, and the Fed prints the money for that, then you're going to have inflation. If that is a probable event in the next 10 years, I'm not saying it's a probable event. It's a probability event with a certainly much higher probability than anyone thought, in 2020 before the pandemic. And even after the pandemic, because they were always going to be temporary and go down, actually the lowest yield was reached, if you know, in actually, I think it was 2021, which was totally crazy. As it was viewed as a huge hedge, and no one believed there was going to be inflation. And now we realize the Fed spends, and they could do it again, and so you got that risk in that market all the time. Now it would take another 40 years for that to totally disappear.
Professor, credit spreads are still relatively narrow, and one of the questions is default rates. Do you view default rates as a leading, coincidental, or lagging indicator?
No, it's a leading indicator. I mean, the markets know. There's been a little widening, I think. Am I right? You follow that a little closer than I do recently.
A little bit, yeah.
But they're still pretty tight. That the soft landing scenario. I mean, it's sort of almost a schizophrenia, because the Fed funds and Treasuries is building, I think a higher probability of recession. Well, it's more of, again, it's the negative beta. It's the fact that I've got the insurance policy. I don't think my house is going to burn down, but I have an insurance policy in case it does burn down. That's the critical thing. I'm going to buy that Treasury because if we do have a recession, I'm going to have something that's really going to go up in price. Not that I think it's going to happen, just like I don't think my house is burning down. But right now, you see, I think, I used to say, people used to say, well, how much is that risk bias in the Fed funds? And I'd say, well, maybe a year out, it might be 25 basis points. Well, I think it's higher now. Why? Because now, explicitly, Jay Powell says he's looking at unemployment and he will respond to it. So all of a sudden, you've got a built-in hedge. If we see the unemployment jump, let's say, I mean, I don't think it's going to happen with the claims being pretty well behaved, but let's just assume, the September payroll is negative and unemployment, jumps to, 4.4 or something, and claims start really going up. They're going to take a 50, maybe even a 75 basis point cut. And if you buy those Fed funds, you're going to make out like a bandit. I want them for that. They're now probably the single best insurance policy. They're expensive, but the single best insurance policy you can now buy for a recession.
Well, as we think about wrapping up, a quick 30-minute call just to get your first reaction. You've talked about 5% real returns for stocks, and that the cutting cycle is useful for small caps value, dividend payings in particular with the lower rates. As you think about sort of going into the end of the year, certainly now the Fed started cutting, they've followed your advice. The election seems like the big wild card.
I don't, and you know what? It's really impossible. It looks like the Republicans are taking the Senate, so it's not going to be a Dem sweep, which means any crazy policy by, Harris or even a Trump, is going to be blocked by one of the houses, and there's going to be a big negotiation. She may be a progressive, so to speak, deep down, but she's going to be probably dealing with the Republican Senate and a House that may turn Democratic by about 5 or 6 votes. So, try to put forth a progressive agenda under those congressional situations. It just ain't going to happen. So, honestly, I do say about taxes, we are going to look at that, renegotiate it at the end of 2025. We'll look at how that, all of a sudden, unbelievable. Trump says he wants to bring back the blue state tax deduction, salt limit, after, he signed to eliminate it when he was president. So, it's really hard to predict.
Debt and deficits for the long run seems to be the new case. But Professor, it's always great to get your take on this, and it's good that they took some of your advice to move.
Yeah. By the way, I will be on. At least the scheduled. Always things can change. An relatively early morning, 6:50 on Squawk Box tomorrow morning. Also asking me about the Fed. So anyone who's up there, happy to have you on, or he's looking on.
And we'll take all these insights, reflect them in model portfolios with the professor. Kevin, always great to get your insights. Thank you all for listening in, and we'll see you all again on our next call.